If you're someone currently saving to a 401k or 403b, or find yourself wanting to do that and learn more, this is the video for you. Today, I'm going to go over whether you should do Roth or pre-tax in your 401k, the definitions between the two, and the math behind it so that you can make a clear and informed decision on how to move forward. First, let's dive into the definition of what Roth is and what pre-tax is. Pre-tax 401k or 403b deferrals are saying that you don't want taxed on the dollars that you put into this plan. So let's say that you put $10,000 over the course of the year into this pre-tax 401k or 403b. Well, that means in this current year that you would not be taxed on this $10,000. But the $10,000 that you didn't get taxed on today, plus any growth over your course of your career, would all be subject to tax when you do take it out in retirement accounts. Roth is the exact opposite. If you put $10,000 over the course of the year in a Roth 401k or 403b, you still be subject to taxes on that $10,000. So it doesn't save you anything in the current year, but all that growth in every single distribution, as long as you held the account for 5 years or more and are above the age of 59 and a half, everything is tax-free from then on out. In more simpler terms, think of yourself as a farmer. I'm planting these seeds today so that they can grow. Do I pay tax now on the seeds when they're little and reap a tax-free harvest? Or do I not pay tax on those seeds when I originally plant them and let them grow and then pay taxes at a potentially lower rate when the harvest comes? The answer is it depends on a lot of things. Your income, your spouse's income if you're married filing jointly, if you're single, if you're head of household, all these things come into play, and I want to make sure that I'm painting a clear picture so that you can make informed and clear decisions going forward. My name is Evan Coffman. I'm a financial planner with Coffman Wealth Management. We help Indiana teachers build wealth. Okay, before I get into the deeper calculations, I want to show you these numbers straight from the IRS website so you know what I'm going off of. So what you see on my screen here, in 2026, the government gives you what's called the standard deduction. Standard deduction means that you can subtract this amount in 2026 from your gross income to save you a little bit on taxes. If you're single, it's $16,100. If you're married filing jointly, double that to $32,200. If you're head of household, it's $24,150. As you see here, these are the rates, the marginal rates for tax brackets for different levels of income. So as you can see here, the lowest one is 10%, then 12, then 22%, then 24%, 32, 35, and then 37. One thing I'd like to point out here, where most of middle America falls, is between these two, 12 and 22%. It's the biggest jump in the entire tax bracket, 10%. So these are the numbers that I want you to pay most attention to. Is because if you fall somewhere in between there, some of your income might be taxed at the 10 and 12 rates, but some might be subject to that big jump in the 22%. If you make over $50,400 of taxable income, which we'll get to that definition in a second, anything over that would be in the 22% bracket if you're single. If you're married, double that. If you make a taxable income of $100,800 between you and your spouse, well, anything over that amount also equals 22%. That's where the decision comes in is, do I do pre-tax or Roth? If I do pre-tax, I can save myself dollars potentially in that 22% bracket, lowering my income and my taxable income below that threshold of $50,400 if I'm single or $100,800 if I'm married. So that's a strategy I'm going to go through. Okay, so on my screen is a rough sketch made by me of the tax brackets when you're working and in retirement. Again, the tax brackets are the same whether you're working or not. The reason I made this chart is I want to make a point. Let's say you're working and your income's high and you're at the 37% bracket. What should you do? Should you defer those dollars in pre-tax contributions, or should you volunteer and pay that tax in the Roth option? Well, if we're at 37% here, we're likely to be in a lower tax bracket in retirement because we're not working anymore in retirement. Maybe instead of 37, we're at 12% in retirement. Well, that big difference there, why wouldn't we defer the tax? Why wouldn't we say, I don't want to pay taxes today, tax me in retirement? Well, that's real savings. That's 37% that you avoided and then paid later in retirement 12. Now, let's say if the opposite is true. Let's say if you're working right now and you're in the 10% bracket and later, maybe you came into an inheritance, maybe your investments did really, really good. And in retirement, I'm going to be dramatic to make a point. that you were in the 37% bracket in retirement. Well, which one would you choose there, Roth or pre-tax? Well, you would choose Roth because your income is lower right now. You're in the lower bracket at 10%. I would pay 10% if I could avoid 37% later. That's the entire point of which one should you choose. What's your tax bracket today and what's your tax bracket tomorrow or in retirement? If your tax bracket is higher today, pre-tax may be the option for you. If your tax bracket is lower today, Roth may be the option for you. It just depends on your situation. Okay, so what you see on my screen here is a spreadsheet that I made to kind of go through the math with you. I have a situation where somebody would do all Roth, a mix of Roth, and all pre-tax. And I did it for both single and married. So I'm going to go through the math with you. So for this first situation, a single person is making $60,000 a year. Estimated deductible medical premiums of $5,000 for the year. And the standard deduction that we saw earlier, that's $16,100. Medical premiums and standard deduction lower your taxable income. So $60,000 minus 5 minus $16,100, that equals a taxable income of $38,900. Well, we talked about earlier that top of the 12%, where that threshold of taxable income, where any dollar over that amount would start being taxed at the 22%. Well, in this instance, our taxable income is lower than that 12%, the top of the 12% tax bracket. So none of our income is taxed at the 22%. This particular person wanted to save 20% of their salary, $12,000. Well, in this instance, they would do all Roth because they're below that 10 and 12%. This one, salary, making a little bit more, $85,000. I'm going to assume the same medical premiums of $5,000, same standard deduction. Well, $85,000 minus $5,000 minus $16,100, that gets us a taxable income of $63,900. And again, that top of the 12% is $50,400. So $60,900 minus the $50,400, that means we have $13,500 of income that's taxed in that 22% bracket. So what do? Well, this person also wants to save 20% of their income, $17,000. So I would tell this particular person, hey, put $13,500 in the pre-tax option, and then because you wanted to save more than $13,500, put it in a Roth. Put it in the Roth option, $3,500. Put the difference between this and this in the Roth option. And then we come up to here, salary of $110, same medical premiums, same standard deduction, $110 minus 5 minus $16,100 equals a taxable income of $88,900. Well, $88,900 minus the top of the 12% bracket, that means that $38,500 of their income is taxed at the 22% bracket. Well, they want to save $22,000, which is 20% of their gross salary. Well, at that point, they should do all pre-tax because all of that $22,000 is saving them in the 22% bracket. Going down to married filing jointly, basically the same numbers, but doubled. I assume one spouse makes $60,000, the other makes $75,000. So that you add those two together, that equals $135, minus $8,000 for medical premiums, minus $32,200. Now that's the standard deduction for married filing jointly that we saw earlier. Well, that means their taxable income is $94,800. Well, as we saw earlier, the top of the 12% bracket where your income starts being taxed at the 22% is anything over that $100,800. Well, our taxable income is only $94,800. That means we should do our Roth, $27,000 all in a Roth. Now somebody might say, well, I thought the contribution limit for a 401k or 403b was $24,500. Well, now you have two. So one person has $24,500 of contributions available. The other person has $24,500 of contributions. One of you are not covered by a 401k. Well, maybe one of you maxes out their 401k at $24,500 with Roth, and then the other does a Roth IRA for the difference. Next, we have a spouse making $85,000. We have a spouse making $75,000. Again, we're subtracting out the $8,000 medical premiums and the $32,200 standard deduction. Taxable income $119. Well, now we're over that $100,800 threshold. That That means $19,000 of our income is taxed at the 22%. Well, we want to save 32. $19,000 goes in the pre-tax option because we're trying to avoid the 22% bracket. And the rest of the 13,000. Last one, salary of 110, spouse salary of 75,000, total of 185. Well, we're going to subtract out those medical premiums and standard deduction, taxable income of 144.8, and we're still above that threshold. $44,000 of our income is going to be taxed at 22%. At this point, all of our savings needs to be in the pre-tax option to avoid our savings of being hit by the 22% bracket. I know that's a lot of numbers to go through, but that is something that you should review every year. Medical premiums may change through your plans at work. The standard deduction usually gets a raise every single year. So these numbers can be different every single year. The other thing you need to keep in mind of is other things that offset your taxes that may actually push you to do Roth. One of them would be the child tax credit. You actually get $2,200 per child. If you made $85,000 and your taxable income actually showed that you might put a little bit in your pre-tax option, well, if we're saving $2,200 per child, well, that actually lowers our effective tax rate. Maybe it would be more opportunistic to go Roth. These are where the nuances come in, and that's where a financial planner comes and provides value. We go through these numbers all the time with our clients at Coffman Wealth Management. If you want to run your own numbers or have any questions on should I do Roth, should I do pre-tax, how much should I be saving, should I do some pre-tax and some of my savings in an IRA, all those questions we deal with all day, every day. So if you want to go over your own numbers and see if you're optimizing for retirement, reach out to us. We'd be happy to help you. Once again, I'm Evan Coffman. I'm a financial planner with Coffman Wealth Management. I'll leave my phone number, email, and a link to our website below. Thank you.